David Burrows, as we said, still joining us from Barometer Capital. Want to start with your bullish take on 2017 and your reasons for feeling that way.
Right. So to be clear, we're bullish on developed market equities.
Okay.
Look, we can have opinions, you have to have process. And ultimately, I'm a big believer in saying what is happening and then try and understand why that is. So what I do know is that over the last number of months, the percentage of stocks in the major indices performing well has been expanding. So in a healthy market, more and more securities should be participating in a rally. Now, I've got this tracked back about 60 years, and I can say that globally about 52% of stocks are in long-term uptrends. In the US, it's about 62%, and that's expanding. So this can go on for a long time. In a bull market, you can get to a point where 70 or 80% of companies are performing well, which means you've got a very healthy market. Okay? We're a long way from that. It can get there and stay there for a long period of time. Now, why is it that things could be getting better? Well, we have better estimates. We have some improving economic data. But when you look at positioning in the market, there's still an enormous amount of cash sitting on the sidelines. When you look at what investors have been doing, the flows were going out of equities into bonds, and that's only just started to reverse. That's been going on for years, like $500 billion out of equities in the last 3 years.
Wow.
So the positioning is still relatively defensive. The technical action is positive. The economic backdrop is improving. And there are, within the market, not everything, some very specific themes that from a valuation standpoint could actually support much higher prices.
Now, financials had been one of the ones a lot of people were keeping their eye on, because at some point in the summer, we were down below 10 times forward earnings for some of the bank names in Canada and the United States. Obviously, that picture is starting to change. People are starting to believe in those names now.
Well, that's true, but we have to remember that they've had very difficult fundamental conditions over the last number of years. I use this statistic. Before the financial crisis, Citigroup had something like 7,000 people in compliance. Today they have 39,000. So regulation has had a heavy drag on earnings, especially in the U.S. Very low interest rates were a real lid on their ability to generate a return. If you look at the U.S. banks, they've traded long-term at 2.5 to 3 times book value. They've traded as high as 4 times their book value. They're trading at 1.5 times. So that's without assuming that their book value can grow. It's without assuming that higher long-term interest rates can help them on the earnings front. So this is something that could go on for a long time. They could get significant dividend growth, which I know lots of our investors are looking for, and get capital growth. And realistically, the valuations actually may be cheaper than you think, because book value is getting better and earnings are getting better. A
lot of excitement, of course, is from President-elect Trump looking to be a friend of Wall Street, wants to deregulate the space and untie their hands a little bit. One thing I noticed, though, during the Trump bump rally, the tech stocks really weren't taking part in it. Why weren't they in favor?
Well, I think it's very clear. As you got into June, July, August, relative strength, or the best performing sectors, became industrials and financials. And technology, which has been leading over the last 2 years, sort of became a source of funds. If you look under the surface of their biggest companies, remember 2015 was driven by about 4 big tech stocks in the US. If you X those out, the mid-sized technology companies actually have performed well right into year end. So the sector itself on a broad basis is still very healthy, while you saw some source of funds. Now, as we get new money coming to market from cash, out of the bond market.
You don't have to sell the FANG stocks anymore to get into the bank and the industrial stocks.
You can see this continue to broaden out. So the tricky part in a bull market is not to sell based on valuation, right? It's not to get shaken out. We're going to get short, sharp pullbacks, get 4 or 5% at any given time. But realistically, you shouldn't expect much more than that, because there's so many underinvested investors.
Now, that's the 2017 view. I understand you're actually looking at a longer-term view, too, taking us several years out.
So to put it in perspective, we believe when we exceeded the high in 2013 of the high from 2000 itself, the new high, that began a new secular bull market, or multi-year revaluation of equities. If you look at history, in early 1951, you made a new high, first time since 29. Market rallied 2 years, corrected over 7 months, about 15%. And then from that point, rallied 100% in the next 2 years, and then continued on for another 10. If you look at 1984, you made a new high in 81, rallied for 2 years, pulled back over 7 months, about 15% in 84, rallied 130% over the next 2 years. And then, of course, rallied through until 1999. So realistically, we made a new high in 13, rallied for 2 years, pulled back through the early part of 16, and we've had a pretty good rally from there. But that's the beginning. We think that we likely have a couple of good years in front of us with some corrections, but that equities probably are the asset class over the next 10, because it's the one asset class that has become underowned and has not been revalued, where real estate has, where bonds have, where many long life assets have been priced well because of a strong bond market.
Fascinating stuff. I know we'll be hearing a lot from you from 2017. And have a great New Year, David.
Thanks very much, and Happy New Year to you.
That was David Burrows from Barometer Capital.